Today I'm talking about Kier Construction. Kier Construction, or Kier Group, is a company I'm a shareholder in, so I will declare an interest in that. It's quite a diverse company, but it's predominantly known in the construction industry. They do hold a lot of contracts, particularly in the government and healthcare sector, also working in railways and nuclear. Healthcare. My main reason for investing in them was really for the HS2 project, which is the largest construction project in the UK currently underway and will be going for quite a long time to come. And as one of the construction companies involved in the project, I'm sure Kier Construction are going to benefit quite significantly. So I'm going to have a look at through the share pricing and the website and show you what's been happening over the last couple of years or so, and some exciting news at the moment. So I'm on the Kier website at kier.co.uk. Let's have a little scroll down and look around and show you what they're all about. So it is a very diverse company. A lot of government contracts, also in aviation, custodial, the prison service, government contract, defence, government contracts, education, government contracts, the energy sector, the environmental work, healthcare, heritage and the arts, highways and bridges, the commercial industrial sector, and leisure and hospitality. So an awful lot of diverse construction work, nuclear and offices. They've been doing a lot of facilities management work as well, involved in railways and signalling, ports and coastal, and some residential. And I think the residential side has been sold off or being sold off, as I understand it. Because Kier has really been going through quite a restructuring. Also doing telecoms work as well, the rollout of 5G, etc. So they are very, very diverse. So let's have a look at the investors page, investor relations. There we go. So this one is the exciting bit of Kier news at the moment. Is a proposed capital raise. Kier have been quite debt heavy in the last few years. They've had a lot of problems, and the share prices you'll see in a moment plummeted from a very nice high point and has been struggling along. But they've been really going through quite a bit of restructuring, and there's been a lot of selling off some parts of the groups, particularly those parts that are not profitable. But they're looking to raise some extra money. It's not quite a rights issue. They're just allocating or issuing a whole lot of shares at about 85 pence a share to existing shareholders. So if you're not a shareholder, you're not going to take a benefit of this one. Current share price, as I'm making the video today, is at 116 pence a share. So the offering at 85 is quite a discount to that. So I think there's an opportunity to take advantage of that. However, I have seen in allocations in the past with competitive companies like Costain, which I'm also a shareholder in, that when they've done something similar, the share price will tend to drop back. And with Costain's case, the share price has remained very much around that offering price for quite some time now and hasn't really moved forward. But there's a lot of things happening in Kier with the sell-offs and things. They're really looking to use the funding to pay off debt to get the finances and the balance sheet back on track again. There is an investor presentation up on the website at Kier, which you can log on and register to go and watch, which is worth a look through if you're looking at investing in Kier. What struck me from it is the profit margin actually trades around 3.9%, which is quite low. So they're relying on very heavy turnover. And of course, if a contract becomes unprofitable or loss-making for any reason, or there are default clauses within the contract, they can be in for very serious losses. And I think they've had some cases of that in the last few years. So it is a tight margin they're running on, but based on a very high volume of turnover. So let's have a little look at Simply Wall Street, see what they've got to say. So the share price has been fairly volatile and it dropped to a low point to the minimum figure at 43p. I think the best figure was around the 43, 45 pence mark as the lowest price per share, but has seen quite a nice climb up there to the current pricing at around 118, it was 120 or so, down to about 116 today. Okay, so that's what they put down as the current valuations. Now, Simply Wall Street, some time back when I first bought into Kier, was showing a valuation price of very, very high. So it was like they had it up to like 80% undervalued. So I thought, yeah, well, that's the time to buy in. But they've restructured their pricing and think fair value is about £1.32 a share. Their 113 figure isn't quite correct today, so no doubt updates overnight. as the price has been climbing again. So yeah, you can see there on the past performance, they've been losing money year on year. The return on capital employed minus 11.6%, whereas 3 years ago was plus 5.5%. So 5.5% was showing really where I was talking about there, the quite tight margins they're trading on. However, if you get it wrong, oh boy, it can drop to a loss very, very quickly. So debt to equity, obviously the amount of this funds gathering from the new issue is really to get that debt to equity balance correct, or in a much happier position really, so that they can begin to move forward again as a business. So let's jump over to Yahoo Finance and let's take a look at those trading figures. So I'm on the 5-year graph at the moment, so you can see 5 years back we were trading up at 14.42 a share. Wow. So a few bad decisions, and the management of those managements changed. The senior management in the last couple of years meant the share prices really dropped down to a very, very low period. So it's down to that. There we are, 47 pence there. So we're slightly lower than that. So it's definitely on the way back up again at 116. So hopefully the new management in there in the last couple of years with their restructuring plans, refinancing the business with the capital raise at the present time, should maybe hope to turn Kier in the right direction, back to profitability, concentrating on core aspects of the business, get back into construction and things they know and understand, and rebuild it to the business it was only even just a few years ago. So it may well be. So that's why I put the video together here, because I think it could be a very strong turnaround play. Okay, so the video as usual is purely for information only and entertainment purposes. I'm not a financial advisor and this isn't financial advice. If you're looking at investing into the business, you need to do your due diligence properly, and we'll catch up with you again soon. Don't forget to hit the like button, subscribe, and hit that notification bell for new videos. You can also get a free share if you sign up with Free Trade or Trading 212. Just need to deposit £1 and away you go. We'll see you soon.